This is Cece. Welcome to the Orbit. We've got stocks higher on this Thursday, January 18th. To start the day, we are up at about 0.4%. We're looking at SPX, about 0.4%. The expected move coming into the day was 0.5%. The expected move as of now, after the open into the close, is about 0.4%. This is obviously following a couple of days, down days in the market, and we are about halfway up back on that 1 week chart, meaning that the expected move today is not back to the highs, but then you look at tomorrow and it kind of is, call it about 4790 to the upside on the expected move, takes you back up near these 1 week highs. Zooming out, you can see where we are on this flag. Let's go out to like 3 months. You can see this sort of consolidation, this flag after this long run. We saw something similar back here around, this was Thanksgiving week. This was, Christmas, New Year's week, and now into January. So that's what we're seeing here. It could just be a consolidation. It could be, taking the chart out a little farther. It could be a period that the market corrects a little bit from, and until that range is violated on the upside or the downside, stocks tend to keep doing the same thing that they have been doing. So we will be looking at that, and obviously anytime if you took out this highs or took out these lows, that would be significant. Taking out those lows would probably spike volatility up a little bit, and taking out the highs would probably get people start to chase stocks, start to chase upside calls, maybe chase some small cap stocks like IWM. Let's just look at IWM real quick. It could have, we're at 190, and remember that 200 level. IWM tried to get above, failed, pulled back. Is that center of gravity still 200? Speaking of earnings season, we've got two of the big names next week. Next week's calendar is actually quite filled, the earnings calendar. But we've got a couple of particular interest with Tesla and Netflix, right? So let's look at Tesla real quick. We've got, this catches the earnings January 26th. We're looking at about a 7% expected move. And what's interesting, we've been talking about this, is what is earnings season going to look like at such low IV levels? And the answer is really that the expected moves, that's a 7% expected move in Tesla. Look down here to the prior earnings moves. This stock was down 9% the prior earnings, it was down 10% the prior earnings, was down 10% the prior earnings to that, was up 11% the earnings 1 year ago. So clearly, you can see where the low IV across the market is affecting earnings moves. Now, sometimes that can be self-fulfilling. There's maybe not a lot of people buying out of the money puts and really far out of the money calls, and they're not demanding a lot for that at the money straddle. Sometimes that can be self-fulfilling, and it's like IV is low because expectations were that Tesla's not going to make a big move. However, that shows you how tight that expected move is compared to the last four. So going to Netflix, we're going to see roughly the same thing. And we've got, I think, about just over a 7% expected move, maybe closer to 7.5%. And Netflix is, 7.5% expected move. Let's look at the prior earnings. We've got 16% last time, down 8%. That was up 16% last earnings. Down 8%, down 3%, up 8, almost 9%. A flag forming into this earnings looks very similar to the broader market. Obviously, with earnings, expectation is for it to decide its next move one way or the other. We will check back in before those earnings with some potential trade ideas. Going back to SPX, let's look at some credit call spreads at that level tomorrow. And remember, that kind of takes us up near those highs. Maybe we'll ask the platform to show us a little bit higher. So let's go into bearish. Let's go to that out of the money credit call spread. All right, so we are at about 47.86, risking 100, risking 400 to make 100. So this would be the type of thing where if you were looking to fade this move and doing it out of the money in case there's 2 days in a row of green, or if today's rally ends up, much more significant to the upside, say up 0.8% or even 1%. Uh, this would take you up back to those highs we saw a couple of days ago, and you would have a credit spread at that level. Now, where you would be legging into an iron condor is if we saw a red day tomorrow, or if this rally today failed, you could then potentially leg into the credit put side of this trade, maybe down near those yesterday's lows, theoretically. So that's one way to get into risking 800 to make 200. You could turn that into maybe risking more like 700 to make 300, or maybe even more than 300 by legging into that condor and using the power of the open of the market to kind of fade into those wings of the condor.